This is John, reporting live from the heart of the markets. Right now, February 9th, 2026, something extraordinary is unfolding in the precious metal space. Silver has just clawed its way back from the abyss. After one of the most violent crashes in modern history, down more than 30% in days, erasing billions in value, spot silver is surging again, trading at approximately $81 per ounce as we speak. But what you're not seeing on the headlines is far more significant. Billions of dollars are quietly pouring back into silver ETFs at an astonishing rate. In the past week alone, the iShares Silver Trust SLV has absorbed over $2.4 billion in fresh capital. The broader precious metals ETF complex has seen more than $2 billion in net inflows. This is not random retail noise. This is deliberate, calculated accumulation by institutions and serious investors who see what most people are missing. The question hanging over every American portfolio tonight is this: is this the beginning of a powerful new leg higher, or are we being set up for yet another devastating trap? Because the stakes could not be higher. Structural supply deficits continue to widen, 100 to 200 million ounces short this year alone. Industrial demand from solar, EVs, AI, and defense is accelerating at a pace mines simply cannot match. And now, with billions rotating back in, the pressure on silver prices is building fast. Many analysts are already whispering the number that seemed impossible just days ago, $100 per ounce, potentially by the end of this month. But timing is everything. One wrong move and the volatility that's defined 2026 so far could strike again. So tonight, we're going deep. We're breaking down exactly what's driving this surge, what the critical levels are for the week of February 9th through 15th, and most importantly, what small and mid-sized American investors like you and me should be doing right now to protect and position ourselves. Stay with me, because what happens next in silver could change the trajectory of wealth for millions of Americans, and the window may already be closing. Let's get to the facts. As of this moment, February 9th, 2026, spot silver is trading at approximately $81 per ounce. That represents a sharp recovery from the devastating lows we saw just days ago, when prices collapsed into the $64 to $76 range, following the late January peak above $120. That single move erased more than 30% of silver's value in a matter of days. Billions of dollars in leveraged positions were liquidated. Stop-loss orders were triggered in cascades. And yet, here we are. Silver is not only holding firm, it is climbing again. And the most important signal is not the price itself. It is the money. In the past week alone, the iShares Silver Trust, SLV, has taken in more than $2.4 billion in new capital. According to ETF Action and fund flow trackers, SLV absorbed roughly $237 billion in a single reported period. The broader precious metals ETF category recorded over $2 billion in net inflows during the same window. This is not scattered retail buying. This is coordinated, high-conviction capital returning to the space after the panic subsided. Institutions, hedge funds, and sophisticated allocators are positioning themselves quietly and aggressively. Why are they doing it now? Because the underlying drivers have not disappeared. They have only become more pronounced. First, the supply deficit is structural and worsening. Independent estimates place the 2026 global silver shortfall between 100 and 200 million ounces. Cumulative deficits since 2021 have already drained roughly 820 million ounces from above-ground stocks. Meanwhile, mine production growth remains anemic, barely 1% to 2% per year. Major producers, including Fresnillo, have already revised output guidance downward to between 42 and 46.5 million ounces for the year. That is not expansion, that is contraction. At the same time, demand is accelerating on multiple fronts. Solar photovoltaic installations continue to consume record volumes of silver, up an estimated 50% year over year in some forecasts. Electric vehicle batteries, 5G infrastructure, artificial intelligence hardware, semiconductor fabrication, and even certain defense applications all require silver in meaningful quantities. This is not optional consumption. It is embedded in the global energy transition and technology build-out. Second, the post-crash rebound we are witnessing is not accidental. The January sell-off was largely mechanical. Leveraged ETFs, particularly those with 2x and 3x exposure, were forced to unwind positions as margin requirements rose and volatility spiked. CME raised futures margins multiple times in a short period. That created a self-reinforcing loop of liquidations. But mechanical sell-offs do not change fundamentals. They create dislocations. And dislocations create opportunity. Analysts across the board are describing this as a healthy correction within a powerful secular bull market, not the termination of one. Third, the macro backdrop is becoming increasingly supportive. The US dollar has shown signs of softening. Geopolitical uncertainty remains elevated. Trade policy frictions are once again in focus. Central banks around the world continue to diversify reserves away from U.S. treasuries and into hard assets. Gold has stabilized near $5,011 per ounce, and the gold to silver ratio, currently hovering around 62, remains historically elevated. In past bull cycles, that ratio compresses significantly, often toward 30 or lower, meaning silver tends to outperform gold dramatically in the second half of major precious metals advances. If gold can hold or climb from current levels, silver has room to run hard. Now let's turn to the week ahead, February 9th through 15th, 2026. This is where precision matters. Current spot price, approximately $81 per ounce, up 3 to 4% on the session. Technical momentum indicators are recovering. The relative strength index has bounced from deeply oversold territory, moving from the low 30s back toward 50. That suggests there is still room to run before we approach overbought conditions. Critical support sits between $76 and $78 per ounce. As long as that zone holds, the structure remains bullish. A decisive break below $76 could open the door to a retest of $67 to $72. Importantly, that lower zone would represent a high conviction buying opportunity, not a reason to panic. On the upside, if ETF inflows remain strong and broader market sentiment stays constructive, silver could realistically test $85 to $90 within the next 5 to 7 trading sessions. Short-term models from Forex, Trading Economics, and others are clustering around $86 to $91 by the end of February. In a best-case scenario, continued dollar weakness, no major adverse economic data, and sustained ETF demand, we could see 90-plus prints before the weekend. Volatility will remain elevated. Expect intraday and weekly swings of 5 to 15%. That is simply the nature of silver in this environment. But directionally, the bias is upward, driven by the same billions we are watching flow back into physical-backed vehicles. SLV share creation is accelerating again. COMEX warehouse inventories remain constrained. Physical delivery pressures are quietly building. If another short squeeze develops, similar to what we saw in late January, $100 this month moves from possible to probable. Let me be clear. January 29th, 2026, silver reached an all-time high of 121.64 per ounce. The subsequent correction was brutal. But history shows that powerful recoveries after sharp drawdowns in bull markets frequently lead to new highs. February has historically been a strong month for silver following volatile Januaries. The ingredients are lining up. Now, let's talk directly to you, the American investor who is not managing a billion-dollar fund, but who is carefully building wealth a few ounces, a few shares, a few $100s at a time. I'm John, just like you, a regular guy here in the United States. I started stacking silver during the 2025 pullbacks. I own American Eagles, generic rounds, and a position in SLV. I have no special access. I follow the same public data you do. And from where I sit, this moment is one of the more attractive entry windows we've seen in the past year. Here's how I believe small and mid-sized investors should approach it. First, buy on weakness, not euphoria. Do not chase strength. Wait for red days, especially if we dip back toward $76 or $80. Use dollar cost averaging. Commit a fixed amount, $100, $200, $500 per week, and execute consistently. That removes emotion and timing risk. Second, prefer unleveraged exposure. Physical silver, American Silver Eagles, or 1 ounce rounds from reputable dealers like APMEX, JM Bullion, or SD Bullion is ideal for long-term holders. Expect to pay 5 at 10% over spot in premiums. That is normal and worth it for liquidity and resalees. For convenience and lower cost, SLV or Sprott Physical Silver Trust, PSLV, shares are excellent. No vault fees, no storage concerns, easy to trade in any brokerage account. Third, never use leverage. The January crash demonstrated exactly why. 2x and 3x ETFs, futures contracts, and margin accounts amplified losses dramatically. Billions were erased in days because of forced selling. If you are building long-term wealth, stay unleveraged. Fourth, think in decades, not days. The structural deficit is multi-year. Industrial consumption is accelerating. Silver's dual role as monetary metal and industrial commodity gives it unique leverage to both inflation and economic growth. Many credible analysts still project $100, $150 by the end of 2026, with higher targets possible if the bull market matures. Silver is already up more than 150% year over year. It has outperformed most asset classes during this cycle. Use it as a hedge. 5 to 10% of your overall portfolio is a common allocation. Store physical securely, a home safe for smaller amounts, a reputable depository for larger holdings. Insure it, diversify, and monitor the key indicators: ETF flows, COMEX inventory reports, the gold-silver ratio, RSI, and macro data releases. Free platforms like TradingView, Kitco, and Barchart make this easy. Right now, the data is screaming opportunity. A personal note, During the 2025 correction, I bought 10 ounces at around $30. Today, those same ounces are worth significantly more. Small, disciplined moves compound. You do not need to be perfect. You just need to be consistent. So here is where we stand. Silver's rebound is real. It is being fueled by billions of dollars returning to ETFs. The fundamentals, supply deficit, industrial demand, macro tailwinds, are as strong as ever. $100 this month is within reach if momentum holds. For the week ahead, expect choppiness but favor the upside. $85 to $90 as realistic near-term targets, with $76, $78 as the key line in the sand. For you, the individual American investor, buy dips, stay unleveraged, think long-term, and protect what you've built. In conclusion, the current developments in the silver market warrant careful attention from every serious investor. What we are witnessing is not merely a short-term bounce. It is the reassertion of powerful multi-year fundamentals in real time. Persistent and widening structural supply deficits, unrelenting industrial and technological demand, accelerating ETF and institutional inflows measured in billions of dollars, and a broader macroeconomic environment that continues to favor hard assets. Silver's recovery from recent lows, now trading near $81 per ounce, is being supported by genuine capital flows and not speculative froth. While near-term volatility remains a certainty, with realistic trading ranges between $76 and $90 over the coming week, the directional bias is upward. Should current momentum persist, a return to $100 per ounce within the month is not an outlier scenario. It is a plausible outcome grounded in the data we have reviewed. For individual American investors, whether you're allocating a few $100s per month or managing a more substantial portfolio, the path forward is clear and disciplined. Prioritize unleveraged positions to protect capital during periods of elevated volatility. Employ dollar cost averaging to systematically build exposure on weakness, rather than chasing strength. Maintain a long-term perspective, recognizing that the secular drivers of this market extend well beyond any single week or month. Limit precious metals. Exposure to an appropriate portion of your overall portfolio, typically 5 to 10% for most investors, as part of a broader diversification and inflation hedging strategy. Stay informed, but avoid overtrading. Reliable public data from ETF flow reports, COMEX inventories, and technical platforms is readily accessible and sufficient for sound decision-making. The opportunity in silver today is real, but it demands patience, discipline, and a clear understanding of risk. Markets reward those who prepare thoughtfully and act decisively when conditions align. This channel exists to provide exactly that: timely, fact-based analysis so you can make informed decisions about your financial future. If today's breakdown has been useful in clarifying the silver landscape, I respectfully ask you to support the channel in the following ways. Please tap the like button to help this content reach more American investors who need this perspective. Subscribe and enable notifications so you never miss critical updates on silver, gold, and broader precious metals developments. Leave a comment below with your view. Do you expect silver to reach $100 by the end of February? Yes or no? Your thoughts help shape future videos. Thank you for your time and attention this evening. Your financial security matters. Stay vigilant, stay positioned, and above all, stay invested in your future. I'm John. We'll speak again soon.